Hi, everyone. Thanks for coming today for our holiday edition of our what we've Emerging Leaders program, which we now are calling the Current Associate Advisor Series Q&A. So hopefully this new forum will be a little bit more engaging. The goal here is for us to be more of a conversation and less of just us talking at you guys. So to the extent you have questions, please leave them in the chat or just speak up. We're happy to go through those as time goes. We've got some pre-filled questions here that we'll go through, but the more interaction we get, the better it's going to be. But thank you guys for coming. I know Kevin and I are really excited. Year-end tax planning is something that we really enjoy doing. It's part of what makes our Decembers busy, but also more entertaining. And so we're talking about tax planning from a different variety of fronts. And here we go. I think the first question that we've gotten so far from people, basically the most common question is, what should I do here if rates go up? There's a lot of discussion about pending tax laws, and those look more likely to pass before, a little bit less likely now, but still probably have the potential to go through. And the question is, in light of that, what happens if tax rates go up? What should I do? And Kevin, I'll kick that over to you.
Brent, thank you. And I'm also very excited for this new format, more of a discussion type format. And we want to hear your guys' questions, everyone's questions. So please feel free to put the questions in the chat or raise your hand. But going back to Brent, the question about the tax rates and linking that to year-end tax planning, year-end tax planning is to plan for, to set expectations for the current year and end of the year taxes and, what's going to be due, or if any additional payments need to be made, but also planning for the next year, planning for 2022. And in regards to, tax rates, are they going to go up? Am I really excited about that? No, overall, but here's why. We look at the original proposal from Biden, which came out in May in his Green Book. And there were a lot of additional tax increases out there. But as the months have passed on and as it has gone through Congress, through the House and the Senate, the provisions have been whittled down in terms of revenue raisers. But there's three provisions to think about. And the first one has to deal with the surcharge in which your adjusted gross income is adjusted gross income in excess of $10 million. There's a potential 5% surcharge. And then if it's over $25 million, there's an additional 3% surcharge on top of that. But then there's also the net investment income definition increase, which would, for those who have adjusted gross income over $400,000, everything else would be taxed with an additional surcharge of 3.8%, all the investment income, I should say. In the past, there's been some ways to avoid this. And they're trying to limit those methods to avoid this 3.8% net investment income tax. So as I look at those three proposals, myself, and having looked at the current status of the bill, I'm not really concerned about it. Myself, is it out there? Potentially it could pass. But I would say for most taxpayers, following the normal year-end tax planning of accelerating deductions and deferring incomes, probably the best bet for about 90 to 95% of all taxpayers out there. That's my personal opinion on it, and it may change on your facts and circumstances, but that's my take. And Brent, yours? And
I think it really just depends on your income level. If you're high income, if you're over that 500,000, then I think there's a decent chance the bill goes through. You're talking another 3.8%. That could be noticeable depending on how much income you just have over that limit. Now, if you're right over the limit, that's maybe not that noticeable. I think if I was selling my business, I'd be pushing real hard to get it through this year versus next year. If it's a $10 million or $15 million sale, all of a sudden we're talking about adding another 5%, 3%, plus 3.8%. Those could be big numbers. I think for, like you said, 95% of taxpayers, it's not going to move the needle too much. We're not talking about an overall rate structure change. We're talking about kind of the add-on ancillary taxes, and so, I think for the right taxpayer, that's selling their business, boy, that would be a real tough pill to swallow if all of a sudden we're talking an extra 11.8% tax on what you were thinking you were going to pay.
Yeah. So if you had a client that did sell their business, or not even that, if the bill passes, let's just play a little hypothetical here. The bill passes and more income is going to be subject to this 3.8%. What are some of the things you think you would do to help bring that down, or at least if you were close to that AGI limit?
As far as like adding on additional deductions, they're trying to push them quicker in 2021.
Either way, either way, what are your thoughts if the bill passes and we're looking at 2022? Kind of look a little bit forward thinking is like, how does a taxpayer hopefully avoid the 3.8% or at least limit it potentially?
I mean, I think you're just looking at classic deductions as much as you can. What are the things that you can, can you push rent expense around a little bit? Can you, maybe you've got some vehicle acquisitions or some equipment that you can purchase in different years. Just playing the timing game, I think, is the best thing you can do. With a big sale, it's tough to move them around too much. You've got a lot of different people getting in the water, negotiating contracts, sale agreements, and whatnot. But
I'm talking about taxpayers that don't have big sales, but just normal. They have a very well run business and making good money, and their AGI is hitting up close to 400,000. What can we do to bring it down? I mean, one of the things that definitely could help is if maxing out any kind of retirement contribution plans, any kind of like you said, deductions or deferring income, like installment sales of any kind of gains, if that's available. That's kind of some of the things that I know that I've used in the past with the clients. So
yeah, one thing about the high income number isn't always the number that needs to be planned around. Sometimes there's other things that come up that you're worried about. Maybe we're talking stimulus money and you wanted to be below a certain amount so you can qualify for stimulus. Or maybe we're talking about child tax credits or education credits, and there's some different thresholds, based on your adjusted gross income that maybe you want to get below. And so maybe you're trying to bring business income down to get below those things as well. So as we talk about 500 grand being a big number, we're also talking about sometimes 180, or 190 to get below some of those things. So yeah, to make your point, kind of ways to drive money down for free are retirement contributions, especially if you're payroll, if you can get them that way. HSA deductions, FSAs, anything for those cafeteria plans or individuals, you can drive down pretty quick.
yeah.
One question that we get the most, and of course came up through this, is, hey, it's the end of the year, should I buy a new car? And I don't know. I think my brother asked me this question as well. So very common one. Kevin, what are your thoughts on buying a new vehicle at the end of the year here to drive your taxes?
My first comment in terms of any kind of a deduction or any kind of spending of money is let's not have the tail wag the dog. I mean, first of all, I want it to be needed by my clients. I am not in favor of just spending money to get a tax deduction and save on taxes, because you're only saving a little. You're saving 20, 30 cents on the dollar, and that just doesn't make sense to me. So first of all, it's got to make sense that there's a need for the automobile. And second, a second thing to consider is with any kind of automobile is how much you're going to use it for business purposes versus personal purposes. I think there's a misunderstanding that, hey, people can get a automobile in their business and use it a lot for personal purposes and still deduct it. That doesn't happen. That's not, in accordance with the IRS guidance and the rules of depreciation and such. So, and if the goal is just for personal uses, again, that doesn't make sense to me. But if they're going to use it for business purposes, again, I'm okay with that if there's a reason. There's also some other rules in regards to weight and size. If you get a certain automobile, like an SUV that's over 6,000 pounds, there are fewer restrictions in terms of current deductibility of the depreciation and such on that. So it's just, those are a couple things to think about. What's the purpose of it? What's the size of it? Are you buying a work work utility car that could potentially be over 6,000 pounds that you can completely deduct this year. If not, then you're going to be limited on some of the depreciation that you can take. IRS considers some of these automobiles as luxury autos, and so you're limited on your depreciation deduction. So then you have to ask yourself, well, does it make sense to buy the automobile if you're limited in terms of depreciation? So it's a multi-pronged factor test to look at in terms of the client. I'm fine with, again, going back to it with your question, I'm fine with it if the client wants to buy it, if it makes sense for them.
One of the things with supply chain is it might not even be possible to get the vehicle you're looking for. I know that the prices are up quite a bit as a result of that. And chatting with my brother the other day, just to put kind of a personal perspective, he's like, do you think the prices are going to go down? He wants to buy the vehicle anyways, but he's kind of like, well, maybe I'm doubly motivated because, I can get it now if I need it now, and I have a tax benefit. But he sees it like, I don't want to pay that price for it. So I think it's an interesting thing.
And another thing that is interesting is if you trade in a vehicle. So cars today used cars are worth more than what they were. Some cars are worth more than what they were purchased for, and so people have traded in their automobiles for another car, and businesses are considering doing that. And with the passage of the 2017 Tax Reform Act, like-kind exchanges automobiles don't qualify for like-kind exchanges. So potentially you could be recognizing income if you exchange a car for a brand new car. That's going to kind of, offset some of the tax depreciation and benefit of a new automobile. So that's something else to consider.
Yeah, kind of to put some numbers on that is, you buy a vehicle that's worth 70 grand, you're buying a new truck, but then you're trading your old truck, it's worth 50 grand. Well, you already wrote off that old truck, you're only getting a $20,000 benefit because you got 70 grand in depreciation, 50 grand in gain, so your delta is 20, and that's really your benefit. So, hopefully the new car was really worth, or the new truck was worth that to make that make sense. But yeah, you're right. You can think you're getting a tax benefit that's maybe larger than you're actually going to get. You're like, oh, I bought a 70 grand truck, I should be good to go. It's like, oh, well, actually, it turns out it's only a $20,000 deduction because you got rid of your old in the process. So certainly something to watch out for. And I think people don't know that piece as well. When they're looking at some of that calculation there.
One of the other things you mentioned earlier that I know surprises people, at least for 2021, the stock market has done fairly well. I'm kind of diverting a little bit, but kind of going back to the earlier discussion about capital gains. And what I've seen with some of my clients is that they have significant capital gains for 2021, and which will have a significant tax impact to them. And so I'm only bringing this up is that one thing that I don't like to do for my clients is surprise them at the end, surprise them come April. And coming back to the idea of year-end tax planning is helping the clients get an expectation of what they're going to be paying. And it's better to get it now than later. So.
Yeah, there was the discussion that capital gain rates might jump up to ordinary income rates for some people. And I think that put a little pressure on the market. I think some people did take some profit there. So I'm sure that is a unique situation that just a couple of taxpayers, and it's not going to necessarily say that's the wrong move that those advisors made, but I think because it's taxpayer, if you're not aware those things are coming down the pipe, that can be a little dicey. Kind of going back to businesses, as we're kind of we'll jump into individuals a little bit more here, but is there like a particular strategy that you're implementing, or like a thing that you feel like a taxpayer shouldn't miss out on right now as we're kind of wrapping up 2021?
Great question. And one thing that I know that we've seen, and at least we've tried to talk to all our clients, but I know that as prospective clients come in the door and reach out to us, I know one of the things that we've seen is the not taking advantage of the employee retention tax credit. And that was a pretty lucrative credit. I don't know if I call it lucrative, but very beneficial credit for 2021. It was also available in 2020. But not as many taxpayers as I would have thought know about it. And especially ones that ultimately qualify for it. So for 2020 or for 2021, the qualifications are actually are much easier than they are in 2020. And in the essence is that if you have a reduction in gross receipts for one quarter, for example, Q1 of 2021 as compared to Q1 of 2019, yes, I said that right, 21 compared to 2019, if there's a reduction in gross receipts of 20% or more, you could qualify for the 70% credit of the first $10,000 of initial wages for an employee. And what we've seen is that this can be very, very beneficial for taxpayers and businesses. And not only do you qualify for Q1, but you also qualify for Q2. So you also qualify for the next quarter. So I think you've seen that too, Brent, haven't you?
Yeah, I mean, if you're a qualifying taxpayer with 20 to 25 employees are going to qualify, we're talking a couple $100,000 per quarter. It can be a pretty noticeable thing. So the analysis is pretty darn simple. You're just looking at gross receipts from 3 years of revenue and kind of comparing them. I think what happened was that PPP was such a big deal in 2020, and it overshadowed this employee retention tax credit program, and it really took all the focus. And it was better initially, and then especially when it got forgiven, right? But this ERTC program just got boosted up in 2021 so much that it's a lot of the smaller tax practitioners just weren't aware as well, because there's a lot of stuff to keep track of, right? I'm not going to try to throw shade at those guys, but it's just something that's easy to miss. And it only takes one quarter being down in order to qualify. And so it's really a big benefit. We've literally been saving clients millions of dollars this year on this credit. So I think it took the low-hanging fruit a little bit there. That's probably the number one thing not to miss this year.
Yeah, and it's important to remember that's a payroll tax credit. So you take those on your payroll tax returns, your quarterly payroll tax returns. Now, I think the other reason practitioners might have missed that is that the rules were significantly loosened up for 2021 as compared to 2020. Brent, can you remind me of what those rules were in 2020 as compared to 2021?
Well, I know the quarter percentage changed quite a bit, right? It was, it's 25 for, was it 50%?
50%. I think it's maybe 50. Yeah. So,
I was told there would be no math on this, but there's no PowerPoint. There's no numbers.
I think that, back to your question though, what was one thing? I think that is the biggest thing to take advantage of, or to make sure that businesses are doing. The other one was to make sure that if my clients have the PPP round 2, that's not treated as taxable income. That is going to be tax exempt income. Not only that, but the taxpayer is eligible to deduct those expenses at the same time. Kind of a double benefit to the taxpayer. Just want to make sure my clients have that. So, yeah.
I think that's up there. I'm seeing a lot of cost segregation studies this year. At the end of the year, we're getting those reports ran. Someone has bought a commercial building and has put it in service in this year. Most of the time, you're going to want to do a cost segregation study just to get the upfront depreciation of that. And we've touched on that in some past sessions before. I think that's another thing that is a business. If you have some of those commercial, you bought something big, being able to write off close to 20 to 25% of that in the first year is a pretty big deal. So that's been kind of probably one of the big things I've seen.
So I got one for you, Brent. Okay. You got a question here. Sorry, let me repeat the double benefit of PPP1. So going back to that great question. So the PPP loans, when those are forgiven, they're tax exempt income. They're not subject to tax. However, at the same time, you're able to deduct the expenses associated with that loan, so the wages you paid. Normally, what happens with tax exempt income is that any expenses that you incur to generate that tax exempt income are not deductible. So there was a little bit of a debate. I say a little bit. There's quite a bit of a debate at the end of 2020 about this, and that the IRS basically said that, okay, you can, that loan, we'll just call it $100,000 PPP loan, that's not taxable to you, assuming you meet all the requirements. But then the wages you paid to qualify for the forgiveness would not be deductible. Essentially, when you think about it, that's making the PPP loan taxable because you're missing out on $100,000 of deductions. Congress stepped in and said, okay, we're done playing this game. We know what the taxpayers want. We're going to give them tax exempt income, plus you're going to get the deduction. So it went against the normal rules that they had set up in the past. So I did say it's a double benefit, but that's what I was referring to. You get tax exempt income, plus you get the deduction for those wages that qualified you for that tax exempt income. So hopefully that answered your question, but great question. Thank you.
Yeah, you get to have your cake and eat it too. And that's what it was billed at. You know, everyone said that was the program to start off with. The IRS just fell back in the old interpretation. So, but
So I'll go ahead, Brent. Sorry.
But yeah, no, it all straightened itself out at the end of the day.
Yeah. So I got a question for you, Brett. I know you know the answer to this. You and I have been doing this a little bit. Tell me about cryptocurrency and NFTs. I've been getting some questions about that. Teach me about that.
Sure. So this is a common question that we get. I probably get a call a week about, hey, I've got all these cryptocurrency gains. What do I do? And when is it recognized? And I think for me, kind of being a finance guy, I like to try to compare everything to kind of things I know. And crypto is treated very much like stock. And so stocks and bonds, you buy them and sell them. If they're short term, if you're held for less than a year, they're long term if you've held for more than a year. And cryptocurrency is really the same way. It's probably more synonymous with a commodity than really a currency, but it's treated very much like a stock. If you've held it for less than a year, you're going to pick it up as ordinary income, which is whatever your marginal tax rate is. So, it's just going to be the next dollar of your income. So that could be, 0 to 37%, depending. Where with the long-term capital gain rates, it's going to be, between 0, 15, and 20%. So, it's just, I treat them like stocks. They're a lot more interesting. They're way more volatile. The volatility of cryptocurrency is pretty insane. One of the things that's a little different than the stock market is that people kind of flip currencies a lot. They buy and sell them, or they'll even convert one currency to another. And the thing that's different is when you're converting, that's a taxable transaction. Once you've switched from one type to another type, you've bought and sold. And so that's a gain event. And so same thing with buying NFTs. When you buy NFT with you got some Ethereum you've had for a long time ago and you go buy it, you go buy an NFT, well, you're switching to a different asset. You've got a recognition event. So, it's not just when you buy and sell, it's also when you convert. And the other misconception around cryptocurrency is a lot of people think they're kind of like IRAs where that money is only taxed when I pull it out. And it's like, no, that's not true. When you're buying and selling and doing stuff, you're creating taxable events. That's just like day trading on the stock market. So, a lot of people think, oh, no, I just left that money in my wallet. It's good to go. No, that's not the case. You have, some taxable transactions, and depending on how good of a job you've done at it, you could have a lot. It's very common for me to get a phone call where, someone's had 70 grand of crypto transactions through the year. It was all short term. It's just all other ordinary income.
Yeah.
And when you add federal and state rates, that could be, 35, 45%.
Yeah, I think boiling it down to the simplicity, if you're holding it, if you buy a coin or a token and all you do is hold it, that's not taxable. But if you do just about anything else, generally that's going to be taxable. I think that's the simplest way to put it. If you're mining, if you're staking, all potentially taxable events. So
yeah, and mining and staking are kind of like buying a CD in my mind. You put your money in a CD and it pays you interest. Yeah, that's taxable when you get the interest, and that's the same concept with staking. And
I was just going to add. I mean, I had a client a newer client that called me, emailed me, whatever, a few months ago and said, hey, is crypto taxable? I said, yeah, if you've been trading. And he's like, oh, I got to amend my returns for the last 3 years. And what's even more interesting is that the IRS has specifically been asking about that. On the tax return, there's a special box. I think it started last year, maybe the year before, that you had to check indicating whether or not you had crypto transactions. So they're going after it much more. And not only that, but it's becoming much more common, much more in everyday, vernacular and such. So.
Yeah, and I think the reporting requirements are coming down the pipe. That was one of the things that's put into the infrastructure bill is to beef up reporting requirements, because it is challenging for people to track that information, because it's not like a brokerage house or like an E-Trade account where they're pretty good about reporting all your stock basis and your stock sales. This is stuff that's a lot of times off ledger, and so you kind of have to keep track of it yourself, whether that's an Excel file or a transaction history. You got to kind of do your best to keep it all together.
Yeah.
Well, here's a good one, Kevin. I'll let you take this one. Is it true that in 2021 there's no limit in cash charitable donations?
It's an interesting question, and I would say yes and no, in the sense that and kind of a little bit of a history lesson is that in the past, charitable donations are itemized deductions. And in the past, they've been limited generally to 50, maybe up to 60% of your adjusted gross income. So basically they're saying, hey, if you can only deduct so much as compared to your adjusted gross income. For 2020 and 2021, that limit was raised to 100% of your adjusted gross income. So yes, in the sense that you can deduct just about all your charitable donations. However, if you donate more than your adjusted gross income, that portion that's in excess of that won't be deductible, but it'll be carried forward to future years. So yes and no, you'll be able to deduct it up to your limit of your adjusted gross income, but the rest will be carried forward. So that's the case. So great question.
And charitable contributions, I kind of like geeking out about this stuff a little bit. One of the things that really changed in the 2017 Tax Act was who gets to itemize and who doesn't. They raised that standard deduction up to, I believe it's 25,100 for 2021 here. So it used to be down 12,800, 13,000 for married filing joint. Now it's 25. And so between that and the SALT cap, there weren't a significant amount of people that itemize it anymore. And so, you really just take medical deductions over a floor, real estate taxes, state taxes up to 10 grand, mortgage interest, and charitable contributions. So really it's just kind of really three things. And a lot of times those numbers don't get up over 25. And so say you're making a charitable contribution, you might, if you're not getting much over 25, you're really not getting much benefit for that charitable contribution. And so there's a few different things you can do to try to maybe maximize the tax benefit as well. I mean, you'll still get it for state most likely, but for the federal side of things, there's a few kind of options you can do to make that benefit a little bit better. And, one thing is maybe you stack the donations. So rather than doing, all your 2021, donations in 1 year and 2022 the next, maybe you stack them all into 1 year, do it January 1st instead of December 31st, so that way you get that benefit all at once. Maybe you load up, they have these products called donor advised funds, which is where you put the money kind of into a holding account that you'll disperse later to charity, but that gives you the ability to front load them too. So if you want to get a really big taxable income year, you want to front load a donor advised fund, you get that benefit all in 1 year right there. And you're allowed to steward that out through multiple years. So another way to kind of front load those deductions. And then there's a couple.
Oh, sorry. Go ahead. Go ahead, Brent. I got another idea about the charitable contributions.
I got two more, so we'll see if I take it or not.
Go ahead.
One is if you have an IRA withdrawal that's coming. If you're over 72, you've got a required minimum distribution. You can contribute that directly to the charitable institution. It takes it right off the top of your income versus itemized, versus running it through that itemized deduction nest. And then the last one that I had was you can always donate stock as well to a charity. And that's a great way to avoid having to pay the tax on any gains.
Yeah.
You're allowed to donate it at the fair market value. So if you had a big gain come in, you wanted that money to go to the charity anyways, you just donate that stock directly to the charity, you bypass having to take that gain and you get the charitable deduction. So
Yeah, that's what I was going to suggest. Going back to the idea of the RMD, just touching on that, just not necessarily the qualified charitable distributions in terms of the RMD, but just to remind everyone, you know, last year was great in terms of 2020 is that Congress suspended the RMD requirements because the stock market took such a hit in March and April, but those are in effect for 2021 and going forward, just as a reminder. And in terms of year-end planning, definitely making sure my clients are taking their RMDs for the year. Otherwise, the penalty could be up to 50% of whatever the RMD was or should have been. So kind of circling back around to, you know, year-end tax planning.
yeah, no, it's something not to miss. You know, for those that turned 72 last year, they might have got a little extra holiday without realizing it. And that, yeah, penalties are substantive.
And I do throw it out there that if you do miss a RMD, usually like on a one-time basis, if you've missed one, the IRS does offer some grace to it, and you can ask for an abatement of that penalty. There's a form you have to fill out, but it is possible to get that penalty abated if you fix the issue quickly. So, yeah.
So we've kind of moved a little bit into individuals just kind of naturally here. Are there any kind of particular individual strategies that you like, Kevin, that, you know, that you're looking at for clients? And what are you planning around, or any just easy money that people leave on the table?
You know, we've talked about a lot of them already in terms of the appreciated stock donations, bunching the itemized deductions. That's a good one. Again, RMDs and making the qualified, you know, charitable distributions to them. So we're touching on a lot of the stuff I've already thought about. One of the things that I want to remind, that I think is also a great reminder, is the Christmas present, I guess you could call it, that the Oregon has given us this year. Do you have any idea what I'm referring to, Brent?
Kicker?
Kicker. Tell us about the kicker, Brent. That's great.
Well, basically, Oregon's got this bill or this plan in place that whenever they go over their collect too much tax revenue, they kick some back. And this year it's 17.2% of last year's tax, I believe. So that could be a big number if you happen to pay a lot of tax last year. If you're paying a lot of tax this year, you should have had it last year, I guess.
Hey, Brent, there's a question in the chat. Do you want to take that?
R&B. I think probably what that question is related to is RMDs, which is an abbreviation for required minimum distributions. They're based on IRAs. So once you got IRAs or 401k, once you turn 72 anymore, you're required to take a distribution out of your IRA each year annually. And if you forget to take it, that's when that penalty comes in. So if you turn 72 this year, you would have until April 1st of next year to pull it out. Kind of lets you end up in a spot where you maybe pull it out twice in a year in that situation there. But yeah, it's an IRA provision that basically they don't want your IRA to grow forever. They want you to use it. And so once you turn, it used to be 70 and a half, it's now 72, you're required to start pulling money out. So required minimum distribution, RMD.
So kind of touching on another thing you asked about, Brent, in terms of year-end stuff for individuals, not necessarily from an income tax perspective, but it's always a great time to remind our clients about the gifting if they do have any desires to make any year-end gifts and the annual exclusion of $15,000, and to remind them about that if they want to reduce their estate, or if they have the charitable inclinations to gift money to their kids or to someone else. It's always just a good reminder at that time of year. And not only that, but to gauge where they're at in terms of giving gifts and whether or not a gift tax return would be required for the year. That's another one.
Yeah, for people that will have an estate, you know, a large taxable estate, which I mean, we're talking for federal purposes, you know, 11.7 is the exemption right now. So above that, I mean, the annual exclusion gifts of 15 grand are just basically free money to get out of the state tax lien. And you can really stack them. You know, if you're married and say you're trying to give to your child and they're married as well, you know, we're talking you can give them 60 grand. If you're husband and wife, and you each give one to each of them, that's 60 grand you can transfer out pretty quick. Same thing if they've got children. You know, you can start stashing money in 529B plans. You know, it's the federal estate is pretty high, and you have that the Oregon state tax. We're talking almost 50%. So, if you are a high net worth individual, you know, the annual exclusion is something that you really don't want to miss. If you like, you know, giving money. Now, not everybody's going to be inclined to give away, and don't give away what you can't afford. But if you're in that situation, you probably can give away a little bit. That's my guess.
Yeah. Those 529. Oh, go ahead. I'm sorry.
No, you go. You go.
I was going to say those 529 plans, giving to a grandchild or a child. That's kind of nice in the sense that you can get a tax break for that. Some on the Oregon side of, you know, for Oregon residents, you know, a little bit of a tax credit there.
Yeah, and you're allowed to supercharge them too, because you can do 5 years at once.
One thing that we haven't touched on, Brent, in terms of new tax law that I've actually had to address or talk with some of my clients on is the new Washington State capital gains tax. Now the people I'm talking to are from up in Washington. I'm sorry. So, you know, I don't know if we have anybody from Washington on the call or if somebody later will hear this, but definitely that has been an issue for 2022. That, you know, historically Washington does not have an income tax. However, they've passed a law which would institute a capital gains tax on capital gains in excess. I think it's $250,000 at about 7.5%, I believe. But that's just another new law to think about in planning if you are in Washington and you have Washington source capital gains.
Yeah, probably targeted at people with stock options. I would imagine mostly there's a lot of Fortune 500 companies that are based out of Seattle. And probably trying to increase revenue a little bit there is where I'm guessing some of the thought process is.
Yeah.
Yeah, and I would throw out kind of one of the other things that I think is pretty powerful is contributing to HSAs in your retirement account. HSAs especially, I don't know, for me, you know, I'm married, I have 3 kids. We burn through our HSA every year, no problem. But, you know, having the ability to, you know, contribute pre-tax and then pay a bill and not have that be income when I pay it is a pretty unique provision. You know, with IRAs, you're allowed to contribute pre-tax, but when you pull the money out, it's taxable. So it's a really unique account in that it allows you a pre-tax deduction. You can also invest it and grow it tax-free, and then pull the money out tax-free if you use it for a qualified medical expense. So I think HSAs are really cool from a tax perspective.
Yeah, and just kind of going off that, so you can, you know, max out your HSA, we'll call it in 2021, incur whatever, we'll call it $10,000 of expenses, not withdraw the HSA funds, but leave them in there for 20 or 30 years, let it grow, and then pull out whatever that was, right, Brent? That's what you're saying?
You can reimburse yourself, yeah.
Later on, like 20 or 30 years later, it's after it grows, it's significant. It's pretty interesting. And what I find interesting too is that's not a provision in all the sections of, you know, the various type of tax deferred accounts and such. So for example, my son is going to his first year in college this year, and he has a Coverdell account. It's a educational IRA account. And that account, it's interesting. It's very much similar to a 529 account, but it's not done at the state level. It's again, it's similar to an IRA, but an educational IRA. You put in money after tax, it grows tax deferred. If you use it for qualifying expenses, you know, educational expenses, it's tax exempt. What's interesting on that one, I'm just throwing it out there just in case somebody has any kids and has a Coverdell account, is those distributions have to be made in the same year as the expense was incurred. And so I've been looking at this recently. I find it very interesting to me is that if I incur, you know, we'll call it $5,000 of tuition in 2021, I have to take the distribution from the Coverdell account of $5,000 in 2021. If I take it in 2022, well, that my expenses in 2021 don't count. I just throw that out there as something to think about. I thought that was interesting.
Certainly less flexible.
Yeah. So again, back to the HSA, again, a lot more flexibility, a lot of good stuff there. So, yeah. One of the things, kind of circling back around to businesses, Brent, I know we've kind of jumped back around. You asked me a question today, and I know we don't got a lot of time left because this has been a great conversation in my mind. But you asked me a question earlier today: is there such a thing as too many deductions? And whether that be at the individual level or at the business level, and kind of starting with the business level, I think that would be an interesting kind of topic to riff on just a little bit.
Sure. Yeah, I think that the concept is, Kevin, you have a little feedback on your side right now on your speakers. Yeah, one of the concepts we're talking about here is just that, sometimes you're not in a bad tax rate, or maybe you have a preferential income. So let's say you've got predominantly capital gain income for the year, or you're, not all tax brackets are high. Sometimes you have lower brackets along the way until you get to the top, top tax bracket. And it's not a bad thing to pay taxes at preferential rates. It's not, you don't always want to flush a bunch of deductions down to offset low tax bracket income if next year you're just going to be in the high tax bracket and you would rather have those deductions at a higher rate. So that was part of the conversation Kevin and I were having. It's just that, sometimes pushing out a deduction isn't a bad thing if you're paying the tax at a lower rate. And to recognize that just having a lot of income isn't a bad thing, because sometimes that income might be taxed at lower rates still.
Yeah. And from the business perspective, the change in the NOL, the net operating loss carryback rules, that's a kind of an issue we talked about in terms of the business level, in that pre-2017, you were able to carry back your NOL 2 years and then forward 20. However, with the 2017 Tax Reform Act, you couldn't carry them back at all. You had to carry them forward, and they were subject to an 80% limitation. Last year for 18, 19, and 20, they changed the law again and allowed you to carry them back 5 years. Well, in 2021, you can't carry your NOL, your net operating losses, back anymore. It falls back to back to the 2017 Tax Reform Act. So incurring a bunch of deductions, you could do it, but the NOL is going to be carried forward, and it potentially could be limited in the future tax years. So, yeah.
Well, I think we'll give it just a sec here to see if anyone has any more questions before we wrap up. But hopefully you guys enjoyed kind of this more new format here, and our holiday theme here in December 16th. We're actually about ready to go to our holiday party after this. So hopefully everyone has a good holiday season, new year, and we'll be back next month. I believe next January the topic is going to be a little bit more robust discussion of cryptocurrencies. Probably the most heavily we get the most questions on cryptocurrency probably in any other topic in the office. So we'll hit that at a little bit harder next month. So but thank you guys for coming. Really appreciate it. And we'll see you next month if there's nothing else.
I might just toss out there, I also want to say thanks. The last, I don't know, how many times have we done this? Is this our 4th time or 5th time? But
something like
thanks
that.
for everybody for attending. And then if there's anybody on the call that has further questions and want to talk, further, just bounce some things off us, don't hesitate to reach out to us. We're on LinkedIn. You can go to our website and find our email addresses. So feel free. Thanks again.
All right. Thanks, guys.